If you're a founder selling a company, there's one document that will determine your sale price more than anything else. It's not your pitch deck, it's not your audited financials, and it's not even your revenue growth chart. It's called a quality of earnings report. And for most first time sellers, you've probably never heard of it. And here's why it is a problem. Every $100,000 of EBITDA adjustment in a Q of E translates roughly to $500,000 to a $1 million range in enterprise valuation. We've seen cases where the gap between what a seller reported and what the Q of E found was over 50%. One company went into the market advertising $1.8 million in EBITDA, but the buyer, they came back with a Q of E at $280,000. Now that is a 16% of what was originally advertised, and the buyer ended up walking away. Today, I'm going to explain exactly what a quality of earnings report is, how it shapes your deal economics, why your audited financials are not enough, and what you can do to make sure that this report works for you instead of against you. Hi, I'm Kishore Dasaka, and I'm a fractional CFO who works with tech founders, preparing them for exits. A big part of what I do is helping founders getting their financials ready for exactly this kind of scrutiny. So whether you're 12 months from a raise or just starting to think about it, this is something that you need to understand. So what exactly is a quality of earnings report? It's a forensic level financial analysis done by an independent CPA firm, and it answers one central question. Are the reported earnings sustainable, repeatable, and real? Now, you might be thinking, I've got audited financials. Isn't that enough? It's not. And here's why. An audit is something that looks back. It confirms that your financial statements comply with GAAP, whereas a QFE is something that looks forward. It asks whether your earnings will hold up after the sale. So even companies with a clean audit opinion go through a QFE during a sale transaction. Because EBITDA, the metric that determines your purchase price, is not a GAAP-defined term. It's never validated in a standard statutory audit. So what does QFE actually examine? Well, it typically has 5 to 7 sections. The adjusted EBITDA analysis, which is a centerpiece of QFE, it normalizes your earning by removing one-time items, the owner discretionary spending. Then you have revenue quality analysis, which looks at recurring revenues versus one-time revenues and customer concentration. And then you have balance sheet review for unrecorded liabilities. Then the working capital analysis, which establishes what is called the PEG, the normalized working capital level that directly affects your purchase price at closing. And the proof of cash reconciliation that validates whether your reported earnings match the actual bank deposits. The deliverable typically is in a PowerPoint deck with a narrative analysis plus an Excel data book with monthly detail. It's nothing like the formal opinion letter that an auditor issues. Now, let's talk about how these findings actually change your deal. At typical low to mid-market multiples of 5 to 10x, every $100,000 of EBITDA adjusted in QFE translates to about $500,000 to $1 million in enterprise value. That is the math that you have to keep in mind throughout this entire section. Let me walk you through an example. A company with $3.8 million in seller reporting EBITDA saw the buyer's QFE bring it down to $3.3 million. At a 6x multiple, that is a $3 million less than what the seller expects. Now, these are not edge cases. This is what happens in a typical QFE process. So that is the impact on your numbers. But there's a specific tactic buyers use to leverage these findings against you. This is what we call retrading, and that is what we'll cover next. Retrading happens when a buyer lowers your purchase price after signing a letter of intent using the QFE findings as a justification. We've seen tech founders where 4 weeks after the deal has been signed and 2 weeks from the scheduled closing, the buyer cancelled and came back with a revised offer. Enterprise value reduced by 20% and cash at closing cut by 30%. Some buyers are known for this. They deliberately gain LOI exclusivity and then systematically renegotiate using whatever the diligent turns up with. And here's why first-time sellers are especially vulnerable to this. PE firms execute dozens of deals every year. You are probably doing it one and probably for the first time. The professionals being paid by the buyer have a natural bias towards identifying reasons to justify a lower price. And once you've signed an exclusive LOI, you've closed off a dialogue with other buyers. The leverage has completely shifted. That's exactly why there is something called as a sell-side QFE, and it changes the dynamics completely. A sell-side QFE is when you, the seller, commission your own quality of earnings report before you go to the market. Over 90% of M&A professionals consider it necessary, and it's becoming the standard for all types of transactions. The cost to the company in this range is typically between $25,000 to $50,000 for this QFE. And usually, the timeline is anywhere between 3 to 8 weeks, depending on the quality of the data. Now, at first glance, that might sound a lot. But let's look at the return. A company with $5 million in EBITDA invested $50,000 in a sell-side QFE. That report them increased the applicable multiple from 5x to 6x. So the sale price effectively went from $25 million to $30 million. That alone is a 100 to 1 ROI on that $50,000 investment. So how does sell-side QFE create value? There are 5 ways. First, your QFE team looks for legitimate add backs that increase your EBITDA. A buyer's team has zero incentive to do this. Second, it's some sort of a dry run. You find and fix problems before the buyers actually discover them. Third, it establishes a favorable working capital peg early. This directly affects your purchase price adjustment at closing. Fourth, it accelerates diligence. When the buyer's team shows up, you've already got a document that is a pre-assembled financial analysis. Fifth, it signals sophistication. Buyers like seeing companies with a sell-side QFE reports because it lowers their transactional risk. And here's the thing, the cost of QFE itself is a business expense that can be added back for EBITDA normalization purposes. So we've covered what a QFE is and how it changes the deal, what retrading is, and why a sell-side QFE is your first line of defense. Now let me walk you through the specific landmines that Indian founders face, because this is where things get particularly complicated. Indian tech companies face a unique set of challenges when it comes to QFE. And the core issue is this. Indian financial practices, regulatory compliances, and accounting standards diverge from US GAAP in ways that standard CA audits can never fly. Let me walk you through some of the big ones. The first one is the Ind AS to US GAAP. Both frameworks follow similar principles, but the US GAAP has far more detailed roots. Development costs for Indian companies can be capitalized under Ind AS, but often have to be expensed off under US GAAP. That directly reduces your EBITDA. Bundled software plus service contracts may be treated as one performance obligation under Ind AS, but split into separate performance obligations under US GAAP. Second, this is important. Your Indian statutory audit is a compliance exercise. It is not in any way a transactional preparation. CAs examine Companies Act compliance, Income Tax Act conformity, and ROC filings, whereas the QFE is an EBITDA sustainability exercise. Revenue quality, normalized working capital, these are fundamentally different exercises. What we've seen quite often is that founders equate audited financials with transaction-ready financials. That is a dangerous assumption. Common discoveries during QFE of Indian companies include promoter personal expenses running through the business, inconsistent accrual practices, under-provisioned employees' benefits, and unrecorded liabilities. The third one is transfer pricing is a major escrow risk. There's a documented case where US software company's Indian subsidiary had never prepared a transfer pricing documentation. The buyer withheld $1.2 million in escrow for a potential exposure. But after specialists got involved, this exposure was reduced to $700,000. But the point stands. Missing transfer pricing documentation for Indian subsidiaries creates an immediate holdback risk. There's also a significant service gap in the market right now. No firm specifically markets sell-side QFE services for Indian service companies in the range for preparing for US acquisitions. The big four firms in India usually focus on larger deals. The US mid-market QFE firms lack India-specific expertise, and Indian CA firms understand compliance but not transaction-focused QFE methodology. So you typically need to assemble a team with a US-based QFE paired with an Indian transaction advisory experience. So here's the bottom line. Spending $25,000 to $50,000 on a sell-side QFE could protect millions of dollars in enterprise value. And this is one of the highest ROI investments that you'll ever make. Documented returns range from 10x to 50x ROI on sell side QFE. The alternative, of course, is letting the buyer's QFE team control the narrative. And we've seen how that plays out. Now, the QFE process touches every aspect of your exit readiness, your financials, your working capital, and your revenue quality. And all that comes together when a buyer walks into your data room. Now, I've made another detailed video on 7 data room mistakes that make buyers walk away. It covers exactly what buyers look for when they open your data room, and if you're preparing for an exit, that might be a next good step.